You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple of things that, are interesting that, individuals tend to do things to cope with inflation in different manners. And, it's one thing to start doing, cutting back on expenses and, these types of issues. But one thing that we're starting to see people do is move to Mexico and to try to get away from inflation in the U.S. Now, this brings up some interesting, thoughts here because, again, we've been talking about the, invasion on the southern border now for quite some time. We've just had trainloads of people literally coming up from, South America, et cetera, into the U.S. across the border. And we've been dealing with the border crisis now for the last, few years in particular. And, this is something that's been going on for a while. Of course, we complain about the illegal immigration into the U.S. Wouldn't it be interesting? And there's kind of a movie that's out. It's called 2012. And this was supposedly the world was supposed to end because of climate crisis in 2012. We've survived that by a decade now. Fortunately, we haven't had the climate crisis yet. So the movie's a bit dated. But in the movie, we have this climate crisis, and so everybody has to flee to Mexico. Right. So, just, kind of reverse border immigration, but people choosing to move to Mexico now to try to get away from, higher rates of inflation. And again, these are the choices that are made. And look, once people move from the U.S. to Mexico, they're not coming back. Right. Once you make that move, just because inflation goes away in the next, 6 or 9 months, they're not going to move back. They're buying houses there. They're moving there. They're getting, transplanted there for one reason or the other. But we're starting to see this migration happening, and this happens, right? There's consequences to politics as and political kind of diatribes that we've gone down. And we've gone down these roads of social justice and this thing, that thing, the other thing, and they all have their roots ultimately. And no matter what it is, whether it's Black Lives Matters, whether it's social justice, whether it's people moving out of the country due to inflation or political climates, et cetera, the roots of all of this comes back down to one thing, which is economic inequality. People are upset. Look, if people are happy, right? If people are happy and they've got a good job and they're able to support their family and the cost of living is reasonable and, life is fairly, complacent, they're not out in the streets rioting, right? You've got to look back in history and you see all this buildup and tensions as this migration. This really kind of began back in 2000 and real kind of earnest. After the dot-com crash, Enron, all that was really kind of the roots of the beginning of this movement within the economy that started creating this wealth gap. And again, this is, coming right off the heels of, choices by the Clinton administration to try to limit executive and CEO compensation that just turned on the water faucets for stock buybacks and share compensation and these type of things. And that was the beginning of where we really started to see this wealth gap begin to explode in the country. And then, of course, it really started to kind of come to a head in 2008 during the financial crisis. Because, again, during the financial crisis, the average person's losing their houses, they're losing their jobs, but the rich people are doing just fine. And that's where we saw the rise of, Occupy Wall Street, where, people were finally starting to catch on that Wall Street was getting fat and everybody else was getting, taken out for slaughter. And then, of course, during the Obama administration and going forward from there, we began to see more and more of these, this division within the country, a lot of it with its roots in economic inequalities, depending on cities where you live or states where you live, et cetera. And this has just been this building pressure within the economy. And this is all really kind of fostered down to the very fact that we have a predatory financial system. We have a Federal Reserve that's complicit in creating that predatory financial system. And then we make bad political choices, doing things like shutting down the economy, thinking we can just turn it right back on again, flooding the system with this idea of modern monetary theory that had disastrous outcomes, creating the inflation we have now. And we've got, administrations that are making choices, again, this whole climate change issue, right? If you think climate change is an issue, that's great. Do something about it, right? Recycle, do these type of things. But one of the consequences of what we have now, or the consequence of these actions for climate change that has led to the problems we have now is, attacking oil companies. Limiting permits. We don't want you to drill. You're bad. You're villainous, right? We need to get rid of oil companies. Now, all of a sudden, because we have $6 a gallon gasoline, which was the inevitable outcome of all this, now you've got the president warning oil companies if they don't drill more, there's going to be consequences. You can't force companies to go drill. And you can't force them to drill if you're not going to give them the permits and remove the restrictions to allow them to drill. And even if they do start drilling today, and look, they have been drilling, oil rig counts are coming up. They have been. A couple of years ago, the administration's all happy because we have negative oil prices, right? We finally got them, boy. We're going to crush these oil companies. Everybody's running out to buy electric cars. Now at $6 a gallon gasoline and, electricity prices going through the roof, it ain't cheap, period. But these are the consequences of the decisions we make. And we make these decisions based on flawed premises to begin with, and then we don't like the outcomes. And again, if you believe in climate change, that's awesome. No problem with that. But the entire premise of how we get from where we were to where we want to be was entirely flawed, and the inevitable outcome is here. And everybody that was talking about this, saying, hey, if you do these things, this is going to be the consequence. We're here now. And guess what? Nobody likes it. And now everybody's trying to figure out how to undo it. And you can't, because you've let the genie out of the bottle. So people are now having to make these decisions about, what do I do to combat inflationary pressures, right? Inflation will take care of itself, as we've said before. And people are making, and the consequence, and how inflation takes care of itself is exactly through the process of what you see happening, which is people making decisions to buy less, to travel less, to do less things, to save more money, move out of the country. These have economic impacts, not in the short term, but also in the long term. Inflation is one thing. Inflation is controllable. We can do a lot of things to try to control the rate of inflation. Deflation is extremely difficult to control because it's a mindset. Once you start getting the reverse of inflation, which will come, you will get into a disinflationary leading to deflationary environment, and this will be coincident with the recession. The problem with deflation is that the Fed has little capability to actually change a mental mindset. And the mental mindset that happens with deflation is that consumers start going, yeah, I see prices are getting cheaper, but I'm going to wait because I think they're going to get even cheaper from here. and then they get cheaper, and then they go, well, I think it'll get cheaper. So they stop that cessation of spending starts to get ingrained as individuals start to look for lower and lower prices during the deflationary spend. And that's why it's very difficult to change that mentality. And that's why deflation is really a much bigger threat for the Fed than inflation. But part of that deflationary process is also financial instability. And those two really go hand in hand. And, the biggest risk for the Federal Reserve is, again, a potential pickup in financial instability that begins to disrupt areas of the financial markets that directly affect consumption. This is your credit cards, your housing, jobs, those type of things. So where is it that the Fed is going to be watching for things? If you start to see jobless claims pop above 300,000, Fed's got a problem. If you start to see employment drop to 150,000 jobs a month, Fed's got a problem. Because once those things start to occur, you're in the trap. Because when those things start to occur, you start to see jobless claims pop up, you start to see employment roll over. Those trends don't stop on a dime. Be right back after the break. Wrap up the show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.